Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
And then I had a couple questions, Jack. One was, I think I've heard you do that Stephen Jen thing a number of times, and I must have been not concentrating enough, but it finally hit me what you were really trying to say. So just trying to, you know me, since I've been in the options market for probably more years than I really want to admit to, I think in terms of options for just about everything. So I wrote down a little question. It says, in option terms, the dollar is a form of a straddle of currency. Strong or weak economic growth is good for the dollar. Is that correct?
It depends on where it's generally coming from. We saw strong relative economic, at least from a nominal standpoint, economic growth during this early 2000s. Yet it was very bad for the dollar. I was trying to make the point whether that's more U.S. centric, where if the capital gains opportunities are offshore, and the government has a weak dollar policy, even strong nominal numbers for U.S. growth are not necessarily going to help the dollar.
But in the 90s, it was the opposite, though, correct?
Correct. We had the U.S. was kind of the driver in terms of everybody wanting to get involved in the capital gains opportunities inside the U.S. market, and so that was very beneficial for the dollar.
Right. So if the opportunities are here in the United States, then the dollar will rise on either a growth surprise or, conversely, a risk bid. Now we're probably not going to see a growth surprise, or we did see a little bit of that on Friday, relatively a growth surprise, correct?
That's right. That's exactly right.
When people are so bearish. In fact, you make that point, and you do a really good job of it, that when when you're trading currencies, it's a relative game, and when you're trading currencies, since everyone says it's all about the interest rates, when we've done these live presentations, you always say to me, Steve, that's true, but it's also about the expectations. It's just a slight change in people's expectations might mean a big difference. I guess what I'm trying to say is because the Australian rates are higher than the U.S. doesn't mean that the Aussie dollar has to rally into perpetuity, correct?
That's exactly right, and I think people tend to look at rates, just static rates, and say, well, the yield spread here is higher than this one, therefore we always have to buy the higher yield currency. That's not true. It's about expectations. The market's already priced in that yield spread to a degree. What they haven't priced in is this idea of what are the expectations going forward, and if they change, and the yield spread can change more positively for the dollar, even if it doesn't catch up, that changes at the margin, and you see money flow in different ways. And what happened on Friday, I think, to a degree, everybody was set really in concrete, this idea that the U.S. dollar is going to be the carry trade currency for a long time. But that Friday surprise changed those calculations on the U.S. dollar as the carry trade currency. A big part of the benefit to the U.S. dollar, those expectations. And again, those expectations didn't say U.S. interest rates are going to go up 3% this week, but it did say if we see a growth surprise, guess what? Interest rates cannot stay low for as long as we expect. Therefore, the U.S. dollar, we better be careful about all of our borrowing of U.S. dollars.
Makes sense. That makes a lot of sense. John has a question, Jack. And his question is, what commodity influenced the Brazilian real? Since the IC is going to start trading that in January, we better know what people are looking at when they're trading the Brazilian real.
Well, all the demand for iron ore and things, Brazil has a lot of different commodities that they sell, and a lot of stuff that they sell, to China, especially in a period when global shipping rates have fallen so much. It makes the, relative the Brazilian commodities, look cheaper. That can change. Plus, you also have going on in Brazil from an economic standpoint. They won the Olympics. We've already seen, even before the Olympics, people were marking up growth rates from 3.5% next year in GDP up to 4.5%. Their interest rates right now, short-term interest rates, are 8%. So compare 8% to what's going on in the U.S. at 0.2 or something. and their inflation rate really isn't that bad. So from a real return standpoint on their interest rates, which again are expected to go up next year, if their economy improves, there's a lot of very good things happening in the Brazilian real longer term. And that's why it soared so much. People wanted access to that market. Brazil has even put in some cap controls to try and slow down the appreciation of their currency. And again, if we see a real risk bid in here, there's no doubt the Brazilian real will pull back. But I think ultimately, if things get back, on a growth standpoint, whether it's U.S. growth, which is beneficial for Brazil, or Chinese growth, which is beneficial for Brazil, and their domestic demand's getting better in terms of not only the depth of demand, but across different industries of demand throughout the Brazilian economy. I think the Brazilian real will have to continue to appreciate going forward. Whether or not that appreciation is as much against the U.S. dollar or maybe against the euro, we definitely see it against the industrialized world currencies in a big way.
Makes sense. I read somewhere, this is another question I had, that there was an analyst said that he thought that the relative monetary policies are going to drive currencies in 2010. What do you think of that comment, Jack?
I think there's a lot to that because there's the outliers, and if we think of the major currencies of the world, the outlier would be probably like the Australian currency, because of the yield is so high relative to the rest of them. But in terms of a pack, all the interest rates have normalized to they're very close. Again, even though the U.S. is lowest, they're very close. So those that start to take money off the table and the expectations of a rising interest rate move up, that yield advantage can change pretty quickly from a percentage standpoint. So when you have interest rates that are very close to one another, then monetary policy starts to play a little bigger role. So I do think that makes sense.
Yeah. John just has one other point about the commodities again in Brazil. He says, is it oil, sugar, gold, or all the above, do you think? As far as, I'm not an expert on Brazil at all. I know that, and I don't even know if they're an importer or exporter of oil. Do you know, Jack?
Well, they just had a massive find of oil, offshore.
Right. Does that mean they're an importer or exporter?
Well, they will soon be an exporter. I don't know.
Oh, they will. Wow. Okay.
Yeah, but plus they also have they've also used have their cars can run on both oil and crossover methane and things. So they've been very ahead of the pack in terms of energy usage, and that's part of it too. But in general, they do a lot of commodities across the board. I don't know which is the highest component, but in general, if commodities are demanded in a growth world, they're going to tend to do well unless there's a major accident.
Right. William says Brazil is a huge producer of ethanol, as you said. Reed has a question. If the dollar begins to rally, which currencies will probably fall most? Fall against, I think I was trying to say which one.
If the dollar rallies on some type of extended risk, say we wake up one day and there's a massive protest in China, which I don't necessarily expect, but say some type of real deep risk, some country just falls off the table that's driving global growth, and it's sustained, the currencies that will get hit the hardest are the commodity currencies. The Australian dollar, and the rest of the commodity pack will get hit the hardest, and then probably the euro second, falling behind in there.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.